Hi, I'm Billy Keels, the host of the Going Long podcast. Every week, I'm going to be here interviewing the absolute best in the business as it relates to real asset investing, as well as real Main Street investors. We're going to be having conversations where you can listen in, and that's going to help you to continue on your path to education so that you feel much more comfortable as well as confident in investing long distance. So make sure that you go ahead and subscribe to the channel. Make sure that you're liking it as well, because that way you can get every single episode as soon as it comes out. And by the way, don't forget to leave today's episode a 5-star review. Let's go ahead and listen to today's conversation. Welcome to the Going Long podcast. We're back once again helping to educate you so that you feel much more comfortable and confident investing beyond your backyard. I'm your host, Billy Keels. And you know what? If you've ever wanted to know how to acquire multifamily real estate and attain total financial freedom by investing in the dream, then guess what? You're going to want to listen to every single word of today's conversation, because today's guest is not only passionate about ensuring success for every investment for his loyal investors. Also, since 2010, he's been involved in over $130 million worth of commercial real estate transactions, going long in states like Texas, Colorado, Louisiana, Oklahoma, and Ohio. And you know what? He's probably going to have to tell us that the numbers have even been a little bit bigger since I just mentioned to you. He's also the author of the book called Investing in the Dream, and he's the co-founder of Wolfe Investments. Welcome to the show, Kenny Wolfe.
Thank you, Billy. I appreciate it. Thanks for having me on.
Hey, Kenny, I am so looking forward to this, man. It's been a long time coming, and I'm sure there's going to be lots of value that all of our audience is going to derive from today's conversation. So, Kenny, we like to get started off here from the very beginning, helping to build bridges and help us understand, what city do you live in?
So I live in Plano, Texas, which is just north of Dallas.
All right. Fantastic. So right there in the great state of Texas. Fantastic. And Kenny, tell us, what has been the most positive thing that's happened to you in the last 24 hours?
It's a good question. I'd say we're just coming off the weekend. So, I spent all weekend with the kids and family in the pool and hanging out and, all kinds of stuff. Just kind of spend a whole weekend with the family. That's been the most, that's the best thing you can do.
Don't you just love that quality time? It's fantastic. So fantastic.
Yeah.
So thanks for sharing that, Kenny. And listen, I've given a couple highlights, but I would love for you to help us understand a bit more about your backstory. Let the Going Long audience understand more about Kenny Wolfe, the man, the investor, the entrepreneur. Talk to us.
Sure. Yeah. So I started out investing in multifamily real estate almost 10 years ago, focused here in Texas and Dallas-Fort Worth area. And then since then, kind of really took the ball and ran with it. We've done over 4,200 apartment units in 5 states, 250 million in acquisitions.
250. There you go. All right. I knew the number was going to be bigger. I knew it was.
Right. And then also too, now we've expanded. So we do 4 things up here at Wolfe Investments. We do existing multifamily, buy those, improve those operationally and physically, improve the property.
Mm-hmm.
We also do ground up development and redevelopment. And then we started buying triple net and double net commercial properties as well. And the 4th thing would be the occasional hard money loan.
Okay. So hard money lending, triple net on the larger commercial development, meaning ground up, and then also on the existing multifamily. So a couple of things. So there are a number of different ways that we could go here, but I guess the biggest thing is, you had the opportunity to do a number of different things. Why real estate? And I guess, why real estate?
So actually before real estate, I was a CFO at the age of 28 doing oil and gas. My dad was in oil and gas. My grandfather was in oil and gas. That's kind of what we did. I went on the accounting side, but still it's either feast or famine in the oil and gas business. And so we were in 3 years of our 5th year contract with the company, working on we were a small company, but we would feed into this. We would sell our mineral leases to this larger company, Chesapeake Energy. Anyways, they had money issues the first time. And so my wife and I looked at each other like, we got to find something else to do that's not as, cyclical. Everything has cycles, but nothing like oil and gas. And so I talked to a family friend. She's a trust fund kid, and I'm big about modeling. So if there's something that you want, or you want to, you want to see achievements in your life, find someone who's done it and ask them how. Most people, I found most people are willing to help do that. So that's what she said. So she said she invested passively in multifamily real estate here in the United States. And so that's how she got all her passive income coming through.
All right. So she got that passive income coming through. You had a previous experience as a CFO. So we'll come back to that understanding of the financials and the different risk mitigation, because I think that's important, and realizing that you were looking for something different where you could understand the cycles, but it wasn't so much feast or famine. And I know we'll have a chance to talk here, maybe not today, but about oil and gas and the way that actually falls into overall real assets. But today we're going to stick more to the residential multifamily. I know that's your sweet spot and what you're really building the business around today. So you talked about a couple of things. So just kind of talk to us more about on the existing multifamily. So I know some of the things that we've started to talk about or helping to educate the marketplace is really on this whole concept of the existing multifamily, and maybe something called value add. So talk to us about, Kenny, how you evaluate or what your definition is of value add, please.
Right. Yeah. So value add, that's what everybody wants, right? Everybody's chasing value add. So how do you create that? And so what we do is we look at each opportunity, an example, we bought everything from an A class, which is your kind of typical nice, newer asset. And we've actually made those value add opportunities. We've bought D class, which is the ones you don't really want to be at during the day, at all. So, and those are massive value add gains, because what we're doing there is just not just improving the asset. We're actually getting rid of residents that don't make that community very nice. And so we've done that numerous times. So, but value add is on a high level. What we're trying to do is create value for that resident or for a new type of resident, new demographic that we're trying to reach. They're in that community, and so that could range from adding a dog park. Doing monthly community events, and also upgrading the interior units. That's always a big deal. Obviously, we first go in and look at life safety issues as well, trip hazards, all things like that. We've seen it all at this point, but really it's creating value not just for your residents, and then that translates to value to your investors.
Okay, fantastic. So, and I know, Kenny, we're going to today get the opportunity, with you being such an expert and really understanding from the management side all the way to the strategy side. There are a couple of things I'd like to go into the weeds a bit more than we do, because there are so many people that are really interested in understanding more about how to understand more about the opportunities that exist. So you talked already about it's about adding value. I'm going to take it another step deeper, and I know you really focus on adding value by increasing what is known as the net operating income, or the N.O.I. And there's a couple different ways that you can do that. So maybe if you could just give us an understanding as to how you go out and increase the value by increasing the net operating income, or the N.O.I, please.
Right. And that's where an accounting background really helps, because you can look at your income statement and you've got probably 10 different kind of levers to pull on the revenue side, and probably 20 on the expenses. Right. And so what we do on the revenue side is, we always try to add a dog park, because dogs pay rent. That's going to add to your N.O.I, right? All of our flooring's waterproof. So we like dogs, no problem there. And then, you can do all kinds of, get creative with it. We have cable contracts where we either get into contract with a cable company that says either an exclusive or non-exclusive. They pay us a big upfront fee. We also get a percentage of all the cable revenues comes off of our property. That's another example. Another would be adding an upgrade unit interior. And so we always have a classic unit and an upgrade unit. And so what that means is your classic unit is kind of not dated, but it's functional, it's clean, we're still providing value for the resident. But for those folks that want to kind of have that HGTV, that wow factor in their apartment, we take it to the next level on inside those units. And that finish out really depends on what market we're in, kind of on how much they can afford. So, but that's a big deal. Is the interior upgrades is a pretty big deal. You got to have that wow factor.
Okay, so looking for the wow factor, you have the interior upgrades, and even before that, one of the things it's really important to highlight. I mean, you're already talking about what is it that the potential resident is really looking for. So we talked about you love dogs, right? And you love dogs because your residents that are looking for the type of units that you have love their dogs. And as a result, they're willing to exchange their capital for an environment to going to be the right place for them. And you also talked about also being able to look at things like the classic unit versus the upgraded units, because you once again are looking to serve the right client or the right resident for that particular opportunity, or for that particular opportunity, I guess is the right, probably the best way to say it. So that helps us there. And you're talking about the revenue side of things, and you also talked about some of the different types of expenses, but ultimately look to drive the NOI. Talk to us about how you look at that, right? Because one of the things we also, I think, is maybe next level is we talk a lot about occupancy,
Right.
and there's the whole concept of the physical occupancy, which most people talk about. But could you also tell us, when you're looking at a new opportunity, like how the economic occupancy also comes into play?
Right. Yeah. So economic occupancy is your physical occupancy minus any kind of concessions that you have, or your evictions or skips. Things like bad debt. There's a whole bunch of things that'll kind of offset your physical occupancy. So, and our properties, we aim for to be 92 to 95% occupied, physically occupied. But also we have to collect money too. So you've got to be able to if you can fill it up with 100%, but if only 80% of those folks are paying rent, then what good, it actually does you worse damage than it does if you had it at 80%, everybody's paying rent. So anyways, that's kind of our metric too, is not just physical occupancy, although that's a big one. It's also, how much are we actually collecting?
Okay, perfect. And collections, yes, are a really good thing. And you want to make sure that you have that cash coming in to be able to better serve, once again, your residents. And so I'm going to pivot just a little bit, Kenny, because I know that you are, one of the things we talked about in the very beginning is, with Wolfe Investments, you are looking to, you work with a number of investors, and you're always looking to provide the right experience for them, and create the right types of returns for them. And when I talk about returns here, we're not just talking about financial returns. We're also talking about, social return, or the things that person is really looking to gain by being a part of your team. And
Right.
so, because this is something you've been very successful at over the years, I'd really love to know, what are some of the things that you are doing to be able to provide, well, I guess to attract the right type of person that could benefit from the services at Wolfe Investments.
Right. So yeah, obviously we are an real estate investment company. So we're trying to get our shareholders not our shareholder, our investors, the biggest return on their money. Also, at the same time too, there's definitely a feel good factor of our business, is that we can go in and make, go and buy these assets, these apartment buildings where maybe the former owner was just taking all the money out, not pouring it back in. I mean, we bought a deal in Colorado Springs where we walked in one of the units, and the guy had said that there had been a leak in his roof for, like, I think he said 5 years, and they never fixed it. So what they did is just they cut out the drywall, put a plastic bag over, and just gave him $50 off his month of rent. And the resident was okay with that, which I wasn't okay with that. And so, like, the day we bought it, we fixed the roof, patched this thing, and then we created so much value for that resident that he told his friends and all that. So, it just really pays off. And we see things like that all the time. We're thanked by our residents typically on the harder turns, when they say, "Oh my gosh, thank you for caring. Thank you for cutting the grass. Thank you for, getting this, my neighbor who was a pain off this property." It's just creating value for your residents, and that's going to pay you back tenfold.
Yeah, well, because when you feel like your needs are being met, and your desires are being listened to, and you're able to get to see that there's action taking place, yeah, I mean, it serves up massive amounts of goodwill, and I'm sure that, it makes a lot of sense that they would also ask others to come closer to you and to your organization. So one of the things I also talked about, as you looked at going long, right, which is one of the things, investing beyond your backyard, you talked about being from Texas, living in Texas, but then I also mentioned that there were 4 other states that you've decided to invest in. Talk to us a little bit about some of the reasons that you decided to invest beyond your backyard, or to go beyond Texas.
Really, I mean, I was really early. I thought DFW prices were really high 6 years ago.
Wow.
So I was really early, I just saw them keep going up and up. And so I wanted to branch out and find other markets where they maybe haven't had that growth yet out of the 2008, 2009 crash, right? To kind of stay ahead of that. So our target was cities that were demographically and historically, economically strong cities, but hadn't had that pop in the rent increases yet that we were seeing here in DFW. And so, yeah, our second purchase was in Colorado Springs. That was awesome. That was a great little property, 192 units. That's the one with the ceiling in it. A lot more stories from that about bears and deer and cougars and stuff. But anyways,
we'll do that on the next conversation.
that one, so many animals on that one. But and then we went to Oklahoma, then Ohio, but really kind of branched out. And the goal was to always go to these cities that we felt that were about to pop in, and people realize, oh my gosh, this is a great place to invest. So Columbus, Ohio was one of those places. I wish I would have bought all of Columbus, Ohio back in 2015, 2016 when I showed up. So.
I wish I would have done it back in the 80s.
Well, yeah, obviously that too, right? But yeah, I mean, it's things like that where we try to stay ahead of the trends in this multifamily investing, which has been turned into a very cool thing to own in your investment portfolio.
So I think so being able to stay ahead of the curve and look for the next opportunity is great. There's also a lot of what will happen when you're looking for teams that are either operating at a very high level, right? And imagine that you are someone who you love living in your city or your country, and you're just trying to figure out, all right, what are the things that I should be looking for, the teams that I should be looking for. Maybe you could talk a little bit about that. You did say there are certain demographics that you're looking for in a particular market, but what would someone who has no idea what they should be looking for? I mean, what are some of those things?
So the multifamily side, we really look at, I'm pretty big on demographics. And so there's this awesome website called city-data.com. And the biggest, I mean, there's almost too much information on that website. But what's really cool is that there's the best one for me and for our team, I think, and they may argue, but for me is there's a map. You can zoom in where your property is, and it tells you the median income, unemployment, employment, all kinds of things like that on a very, not just a zip code, but almost like a 2-block radius. I mean, it's so tight, which is great because that really shows you, and it's all in purple, but the darker the purple, the higher the median income. So if you're buying in a light purple section surrounded by these dark purple sections, well, it might be a good spot to invest. But median income is a big deal because if they're not making a lot of money, how are they going to pay you rent? And especially if you're going to go in there and buy a property and do these interior upgrades and get an extra $100 to $150 a month in rent premium for that upgrade unit, can you get that on a median income of $30,000 a year? Probably not. So that median income is a huge factor for us up here.
No, and I've heard you talk about that before, and really looking at that compared to the price per door as some of the different things that you like to be able to look at to see the sustainability or the potential within a particular property. So I think those are another one of the things that can help someone to say, okay, the educated type of questions that they can ask just to get a sense of a specific opportunity. How would you? Because you've been on the passive investor side, and obviously now extremely successful on the active side, and really wanted to talk to that passive person once again and say, okay, well, you've talked a little bit about understanding, staying ahead of the curve in some of the demographics and some of the metrics we've just talked about. But when you're looking at a team, like what would you say when you go back to when you were just doing passive investing and getting started? Like what were the things that you were looking for in terms of alignment or looking to place your trust in another team?
Right. Yeah. So what I would, when we started out doing 2 passive deals to kind of learn the ropes. And so that's kind of our background. The question was who's actually going to drive the ship? Who's the deal sponsor? Who's the syndicator that's going to drive this ship? Because there are curveballs. That's a baseball terminology, but but there's things that come at these properties because they're very operational heavy. That this sponsor is going to have to be able to handle. So that's a big question. And the second would be who's doing the day-to-day management on the property? Who's their property management company? Do they own it? Do they run their own? Those kind of questions to me are the big 2 questions to ask initially.
Okay. And then how can you test that, right? And I'll go back to the curveball because I'm also used to play baseball, and this is one of the ways we help people understand, right? Just different things.
Right.
So how can you test that? How would you recommend someone say, okay, well, yeah, this isn't going to be their first rodeo. They've done it before, but I need to actually feel comfortable that they're going to be able to handle the unforeseen, because at the end of the day, that's kind of what it is.
Right. Yeah. I mean, it's really just track record. Ask them like, what's the deal that's gone sideways on you, and then how did you shift, and how did you get it back on track? That to me is a big deal. Also, you want to look at their management company they're using. So, I'll pick on Columbus, Ohio, but when we were first showing up there, my goal was to buy, properties built in the 70s and 80s. That was my goal, was buy 70s, 80s product up there. So I needed to find a property management company that did not manage 2000 and newer properties, because sometimes that doesn't translate to B and C class assets. So you want to find a property management company that has a lot of experience in that city, thousands of units in that city if possible, and then in that specific asset class as well.
So, and I just want to reiterate that, because if you weren't listening to what Kenny just said, this is super important, because it is not just about a property management company. What he said was a property management company in the area that understands the asset and the asset type, because that's also going to translate into understanding the area, the potential. And as you mentioned, if someone's working in A-class marble countertops all day long, that may be difficult to translate into a C or D-class property, because the demographic is just different. So go back and rewind that and listen to it again, because he just explained it as a piece of like platinum advice or recommendation. So thanks for sharing that, Kenny. It's super important. One of the other things, so let's say help someone maybe move to the more active side of things. If you can share one of the ways that when you're looking at a particular opportunity, and you're very well placed to talk about this, you look at the opportunity and you decide that you want to move forward on that opportunity. You have a lot of numbers, you have a lot of exterior opportunities, internal things that you can do. But how do you get to the point, or what is the process, without giving away your secret sauce, of course, to really understand how you can structure a deal to provide a certain type of return? And whether that return is, I don't even want to make up a number, whatever the return is that you're going to put on a particular thing, it's kind of like getting to the backside of the opportunity to figure out how you can provide value to your investors. Hopefully that's a clear question.
Yeah. So what we try to do is we always try to double the investor's money in either 5 years or less as a total return. And then within that, we try to hit about an 8 to 10% annual cash on cash return. That's included in that doubling in 5 years. So if we can't get there on that, then we just pass on the deal. I know a lot of folks have kind of changed as we got to a hotter and hotter market. They kept lowering that total return mark. So I started in 2010. So I didn't go through the last recession, but I asked a lot of people, what did people do wrong in 2007, right? And it was that they adjusted their returns. I mean, if you bring your expectations down, that's to me kind of a dangerous thing to do, because you're trying to fit that, square peg in a round hole. So for us, we just pass on it. And that's why we've been so, just move on to the next city. If we can't make the returns work, then we move, and we keep looking for in that city, hopefully to build our footprint eventually. But if we can't make the deals work, we don't buy them.
Okay. Yep. Keep it very simple. And I know that you have a formula that works. Don't overcomplicate things, right, and make it easy to understand, easy to translate, and everybody can just sleep well at night. And I think that's really, really important. Kenny, so we're also, in terms of help us understand, like from a travel perspective, right? Because one of the things that I recognize, like living in Europe and building business that is US based, there's a really important dynamic that comes to meeting with people face to face. And that can be potential investors, that's your team. How do you manage that across 5 different states and being based in one of those places where you do business?
So on the investor side, we used to hold a monthly live in-person meetup till all this virus stuff hit. But so we still do that online virtually. We'll get back to the in-person deals. We hold live conferences 3 times a year. The last one was in Houston in January. We had 400 people show up. We oversold the room. It was amazing. I'm surprised.
Well done.
let's get away with that. But anyways, so that kind of in-person meeting stuff as well. We push out a lot of digital content as well. We've got a YouTube channel, Facebook. We're heavy on social media to kind of reach new people. We've got investors from Guam all the way to, I don't think we have a European investor yet. We're working on that though, but
not yet.
So anyway, so that's kind of on the investor side, and then actually on the operation side. About 2.5 years ago, I bought a management company because I got frustrated using third parties. So we brought that in-house. And in about 6 weeks, we're about to buy an Ohio-based management company to bring that in-house as well. So we'll have all of our stuff in-house. That's a big help, I think. It creates a better product and control over what we can offer, not just our residents, but also our investors as well. But I'm also I fly a lot on American, so that's another thing too.
Yeah. Okay. All right. Well, that makes two of us. And just on that, when you talk about vertically integrated, just so that everyone understands, it means basically that you are in control from soup to nuts, so to speak, as it relates to anything that has to do with your residents, whether attracting residents in the maintenance, as well as off or exiting any residents. So doing that versus doing or working with a third party. Maybe you could talk to us. You mentioned one or two, but just some advantages of being able to do that, number one. And then when does it make sense for someone's business, in your estimation, to go vertically integrated?
Sure. Yeah. So to me, one of the best things to do. There's three big expense line items on your income statement on a property. It's your property taxes, your insurance, and your payroll. Well, we can fight property taxes all day long, and we do that in most of our states. Payroll, it is kind of what it is, but insurance is a big deal. So now that so the second I got to 1,000 units and that I could place the insurance on, I got a big discount on my insurance, which is a big deal because again, it's number 2 or 3 on your expenses. And so, but now that we own the management company, now we've got under this one 4,500 units that we can place the insurance on, and not just us, but other folks that use us as third-party management get that discount as well. And then when we buy the second one, we'll be at like almost 10,000 units, and then for there, it's huge. It's a massive increase for again the investors on that. And then but also too, it's a way to kind of control to create a better mousetrap. Is bring in the best talent you can, create a better experience for your residents, have better reporting for your investors, things like that.
I think that's phenomenal. So there are some operational efficiencies that are created there, and then also what I heard you say is it's really about speed and control.
Right. And then you have to think about unit count, but when it makes sense. Really, you probably need. You could shoestring it maybe 1,500 units, but it's going to be tough to attract good talent to run that for you. And so I'd say there's kind of the minimum, probably around 2,000-3,000 at that point, and then it probably starts making sense.
Okay. All right. Fantastic. So that makes a lot of sense. Well, listen, Kenny, I want to just keep talking to you forever, man, and I'm sure everybody wants to continue to listen. So, but I know we're getting close to the end of our time together, and because of that, it gets to the part of the conversation which we like to call the going long final 3. And I only ask those going long final 3 questions as long as you tell me that you're ready for me to ask the question. So, are you ready?
Yeah, let's do it.
All right. Very cool. Awesome. So look, I know you've traveled all around the world. You've lived in a bunch of different countries. I am always interested in understanding, what is your favorite European city, either that you visited or still on your bucket list?
So visited is really tough for me, actually. It's between Paris and Rome. But I'd have to say Paris, I guess, is the closest, by a small margin, number one for me. So.
Okay, awesome. So I started my 1-year sabbatical that's almost been 20 years now in Paris. So great vote for Paris there. Fantastic. Second thing, Kenny, you are a successful entrepreneur, investor, mentor, coach, and speaker. And I'm going to guess along the way, you've probably only made one mistake, only one. Would be my guess. Right. If you could think about that one, or what one lesson would you want to pay forward to someone who's looking to really get started or take their game to the next level? What one lesson would you pay forward to them?
So the one that comes to mind is we bought 2 student housing assets down in Waco, Texas, and We thought we figured it out. There has some challenges, mostly because you have to turn the units. About 80% of your units be turned and leased out within 90 days, right? So it's a lot of work there. We thought we figured that out. I would not buy student housing again. The project's going to go okay. It's not going to be great, but it's a deal where there's a lot of really, you can't make a mistake in those 90 days, because if your manager's off one day or your maintenance is out that week, it's really tough to turn those 80% of your units and lease them up. And it's very unforgiving because come mid-August, when all the kids are back in college, you're not going to get very many leases for the next 12 months. So it's very unforgiving if you mess that up on the operations side.
Okay. So really understand what you're doing, or surround yourself with people that really understand what they're doing. And even in spite of that, you're going to have to potentially be ready to have a learning lesson.
Yeah, exactly. I mean, like I said, we thought we figured it out. We thought we knew, we thought we hit all the risk points. And it's just not, in my opinion, worth it.
Okay.
But we know colleagues that make a lot of money in student housing. They just haven't figured it out, I guess, and understand it a lot better than we do. So.
Okay. All right. Sounds good. So, and the last question is, what book are you recommending?
I'm a huge Warren Buffett fan. I go every year to the annual event when they have it in person. I try to go up there every year. I've always liked him since I was 16, 17 years old. So I've been studying him. So I'd say Snowball is probably my favorite book of all time.
Okay. Awesome. So we have another vote for Snowball. Fantastic. And by the way, I didn't mention it, but we're going to make sure that it's in the show notes, or I did mention it at the beginning, that your book is going to be in the show notes. Once again, investing in the dream. So we'll make sure that everyone has access to it there. And I know you have a nice opportunity for people that want to get started reading the book. So we'll make sure that everyone gets access there. So, Kenny, man, there's so many different things that we talked about today. It's been a lot of value add. Really appreciate you talking from the early days in oil and gas and CFO. And even before that, having traveled and lived in some other different countries around the world, giving you a very unique perspective that even after having an understanding of the numbers and the accounting and finance background, that's really been able to help you to have a unique perspective on the way that you are building your business today, really focused on adding value to your investors, making sure that in each and every opportunity that you have, whether that's around existing multifamily, whether it's around development, the triple net leases, and even the hard money lending that you're into nowadays, that you're always providing value for others. You're spending time on the circuit, number of live events. People get a chance to learn from you there. You're giving us a wonderful opportunity to learn from you today. And listen, there's so many things that we could just keep talking about. And I know everyone has gained lots and lots of value. And I'm sure people are like, dude, I want to get in touch with Kenny. How do I do it? You got to tell me, how can I learn more about this guy? So make it really easy for us. What's the best way for people to learn more about you and more about what you're doing at Wolfe Investments?
Sure. Yeah. So the best way to get a hold of us is Wolfe, with an E-investments.com. Hit that subscribe button about a third of the way down. It's a big red button. You can't miss it. Then also, check us out on social media, Facebook, YouTube channel, LinkedIn, all the places you typically find people. So.
Okay, well, perfect. We're going to include that in the show notes as well. And definitely go to Kenny's YouTube channel. They're doing a lot of really great things over there. And those Facebook pages continuously. You're doing lots to help to educate the marketplace. So definitely go and check out all the things that Kenny's doing. Kenny, I want to thank you very much once again for myself and the entire Going Long audience for taking the time to join us today to share your expertise, your insights. It's been really, really helpful. Thank you.
Absolutely. Thank you, Billy, for having me on.
All right. Awesome. So listen, once again, as we're just getting started, everybody, I'm going to go ahead and ask you once again, I'm going to thank you first and foremost for listening to us today. Share today's episode with at least 2 to 3 other people. By doing that, you're actively participating and bringing other like-minded people to our community here at the Going Long. Also, too, take the time just to leave us a written review. I mean, Kenny and I both really want to understand what did you find the most valuable in today's conversation? What would you have liked to hear about? We'd love to have you leave those comments and your reviews there. And listen, I'm really looking forward to welcoming you back to the very next episode. And until then, go out and make it a great day. Wow. Don't you love hearing from top-notch experts in the field? You know, when I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you liked today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.